I'm going to tell you something that may sound harsh but needs to be said with the brutal clarity that only decades of observing financial markets can bring. If you're saving money, thinking you're building wealth, you're probably doing exactly the opposite, and I'm going to show you the relentless math that proves it. Over the past 100 years, I've studied wealth formation patterns in more than 60 countries, and what I discovered goes against everything your parents and grandparents taught you about money. Traditional savings, the one you learned to value as the supreme virtue, is silently destroying your purchasing power at a speed you can't even imagine. And if you're not already subscribed to this channel, subscribe now, because what I'm going to share in the next few minutes could be the difference between building real wealth or working until you're 70 and never achieving financial freedom. Let me show you exactly what I'm talking about. In 1970, if you saved $10,000 under your mattress or in a traditional savings account, do you know how much that money would be worth today in real purchasing power? Only $1,500. You lost 85% of the real value of that money simply by trying to be conservative and safe. But here's what no one tells you this clearly. If those same $10,000 had been invested in a simple diversified portfolio of 60% stocks and 40% bonds, it would be worth more than $800,000 today. The difference between $1,500 and $800,000 is not luck. It is not perfect market timing. It is simply understanding how the economic machine really works. Inflation is an invisible tax on those who keep money idle, and it is the cruelest tax because you don't see it being charged. You just wake up one day realizing that you have worked your whole life and have nothing. Over the last 50 years, average inflation in the United States has been 3.8% per year. Does it seem like little? I'll show you the devastating mathematics of this. With 3.8% annual inflation, your money loses half its purchasing power every 18 years. This means that if you are 30 years old today and save money until you are 66, when you retire, every dollar you saved will only buy 25 cents of what it buys today. You worked decades to accumulate a quarter of the real value. And here's what makes me genuinely concerned looking at the current data. From 2020 to 2024, accumulated inflation was approximately 23%. If you had $100,000 saved in 2020, today, that money buys the equivalent of $77,000 from that time. You lost $23,000 of purchasing power in just 4 years without doing absolutely anything wrong except believing that saving money was safe. The security you sought was actually the mathematical guarantee of slowly becoming impoverished. And I want to know from you, where are you watching this video from? Leave a comment telling me your city and country, because this phenomenon of impoverishment through traditional savings is happening globally, and I want to understand how different cultures are dealing with this brutal reality of economic data. Now, let me show you the 5 mathematical signs that prove that saving money in the traditional way is making you poorer with each passing year. The first sign is what I call the negative real rate of return. When you put money into a traditional savings account today, you are receiving an average of 0.4% interest per year in the United States. But inflation is at 3.2%. This means that your real rate of return is minus 2.8%. You are literally paying to keep your money. For every $100,000 in savings, you lose $2,800 of real purchasing power per year. In 10 years, $28,000 of wealth has evaporated. The second sign comes from the brutal opportunity cost. While your money returns 0.4% in savings, the S&P 500 index has had an average return of approximately 10.5% per year over the last 40 years. The difference of 10.1% per year between savings and investment in shares means that for every dollar you keep idle, You are giving up on multiplying it 45 times in 40 years. $100,000 invested would turn into $4,500,000. In savings, they would become $117,000 nominal, but only $30,000 in real purchasing power. You chose to have $30,000 instead of $4.5 million simply out of fear. The third devastating mathematical sign is what I call the money illusion trap. Your brain sees the number on the BAE account you want to increase from $100,000 to $105,000, and you feel good, but you don't realize that what you can buy with that money has decreased. In 1980, a dollar bought the equivalent of $3.25 today. If you saved $1,000 in 1980, today you have $1,000 on paper, but you can only buy $308 of what you bought back then. It lost 69% of its real value. Your brain sees $1,000 and thinks you haven't lost anything, but mathematically, you've been destroyed. The fourth signal comes from wealth formation data. I analyzed 10,000 cases of people who became millionaires in the last 5 decades. Only 3.2% did this exclusively through saving income from work. 96.8% combined savings with investment in assets that generate returns above inflation. The math is simple. To accumulate $1 million in 30 years by saving $1,000 a month at 0.4%, you would have $364,000. $636,000 to go. Now, at $1,000 a month at 8% real return, you would have $1,486,000. The difference between never getting there and exceeding your goal is simply understanding that money that is still there dies. Money that is invested multiplies. The fifth and most worrying mathematical sign comes from what I call the accelerated rate of impoverishment. In the last 5 years, the correlation between a high savings rate and wealth formation has completely broken down. Countries with higher savings rates such as Japan, Germany, and Switzerland saw the average purchasing power of savers fall by between 15 and 22%. Meanwhile, investors in real assets, shares in productive companies, and income-generating real estate saw assets grow between 38 and 56% in the same period. The difference between the two strategies has never been so brutal. And here's what no one explains to you about why this happens. Governments around the world constantly print money to finance deficits. In the United States, the monetary base increased from $800 billion in 2000 to $9 trillion in 2025. This means that there is more than 11 times as much money circulating today as there was 25 years ago. When you increase the amount of money but do not proportionally increase the amount of goods and services in the economy, each unit of money is worth less. It's basic supply and demand math. If there are 11 times as many dollars but only twice as many goods, each dollar is worth approximately 1/5 of what it was worth. Holding dollars is like trying to hold water in a sieve. The more you squeeze, the more it slips between your fingers. Let me tell you what happened to someone who taught me to never make the mistake of confusing security with financial wisdom again. In 1995, I met an executive at a technology company in San Francisco who at 42 had saved religiously for 20 years. He had $450,000 in certificates of deposit and savings accounts, zero debt, and was proud of never having risked his money on investments. For the next 25 years, until 2020, he continued to save 10% of his income, lived modestly, and accumulated another $300,000 in savings. In 2020, at the age of 67, he had $750,000 nominal. It sounds impressive until you do the math on actual purchasing power. That $750,000 in 2020 bought the equivalent of just $280,000 from 1995. He worked for 45 years, saved religiously for almost half his life, and his wealth in real terms barely grew. Even worse, a co-worker of his who in 1995 invested just $200,000 in technology stocks and held on to it over the decades saw that money turn into $8,200,000. The difference between $280,000 and $8 million is not luck, timing, or genius. It is simply understanding that saved capital rots. Invested capital multiplies through the compound profits of productive companies. The second story that taught me this lesson in an even more painful way happened in Argentina during the 2000s. I met a family that in 1998 had saved the equivalent of $120,000 in Argentine pesos, saved in bank accounts that paid nominal interest of 5% per year. They felt secure because they had no debt and saw the number in their account grow. Between 1998 and 2002, Argentina went through a devastating currency crisis. The peso that was worth $1 was now worth 33 cents. Overnight, those $120,000 became $39,600. But it didn't stop there. Subsequent inflation from 2002 to 2025 eroded another 78% of the value. Today, those original $120,000 are worth approximately $8,700 in real purchasing power. The family lost 92.7% of their wealth by doing exactly what they thought was safe, saving in local currency and keeping it in bank accounts. Meanwhile, Argentines who kept even a modest 10% of their wealth in dollarized assets or shares in exporting companies preserved purchasing power. Those who had 20% in real assets emerged from the crisis even richer in relative terms. The brutal lesson I learned from watching dozens of these cases around the world is that security doesn't come from holding money. Security comes from owning productive assets that generate value regardless of what happens to the currency. Companies continue to sell products, properties continue to house people, commodities continue to be necessary for the economy to function. Money is just paper or digits on a screen that governments can multiply with a click. This fundamental difference between money and real assets is what separates those who build wealth from those who work their entire lives to have enough to survive in retirement. And here is the framework I use to navigate 6 major economic crises and preserve not just capital, but multiply it, while most saw equity evaporate. I call this the principle of productive capital allocation, and it is based on an economic truth that has stood the test for centuries. Capital allocated to productive assets grows at the rate of economic productivity plus inflation. Capital stored in currency grows to zero and loses to inflation. Mathematics is inexorable. I'll give you a concrete example. The American economy has grown on average 3% per year in real terms over the past 150 years. Average inflation was 3%. Return on capital invested in productive companies was approximately 6% real plus 3% inflation equal to 9% nominal. Return on capital in savings was 0 real minus 3% inflation equal minus 3% real. With each passing decade, investors have 2.38 times more capital than savers. In 5 decades, it has been 108 times more. This is the mathematical machine that creates the wealth inequality you see in the world. It's not exploitation. It's not luck. It's simply a consequence of understanding or not understanding how capital works. And here are the 7 specific actions you need to implement immediately if you want to stop becoming impoverished through the illusion of security of traditional savings. The first action is what I call mental reconfiguration about the concept of risk. You've been taught that saving money is safe and investing is risky, But the data shows exactly the opposite. The biggest risk you face is not the short-term volatility of investments, it is the mathematical certainty of losing purchasing power by keeping money idle. Volatility is temporary. Inflation is permanent. In any 20-year period over the last 150 years, American stocks have had a positive return in 100% of cases, even including all crises and crashes. Savings had a negative real return in 87% of 20-year periods when adjusted for inflation. So which one is actually more risky? The asset that fluctuates in the short term but always grows in the long term, or the asset that appears stable but guarantees its impoverishment? The mental shift you need to make is to understand that risk is not seeing your investment drop 15% in a bad year. Risk is being sure of losing 3% of purchasing power every year forever. When I understood this decades ago, I stopped losing sleep over market fluctuations and started losing sleep thinking about how much wealth I was failing to build due to irrational fear. In practice, this means that you need to calculate not how much nominal money you have, but how much real purchasing power you have. If you had $100,000 5 years ago and you have $110,000 today, you didn't gain 10%. You lost approximately 8% because inflation was 18% during that period. Your brain sees nominal growth and feels good, but mathematically, you have become impoverished. Start measuring your wealth in baskets of goods that you actually consume. How many basic supermarket baskets does your money buy? How many months of rent? How many cars? When you measure it like this, you realize that having more zeros in your bank account while each zero buys less is just an illusion of progress. This reconfiguration mental health is painful because it forces you to admit that you wasted years, maybe decades, doing what you thought was right, but was mathematically wrong. But the pain of truth today is better than the pain of regret 20 years from now when you look back and realize that you worked your whole life to have less than your parents had by working less. The second critical action you need to implement is to build what I call a 3-layer monetary impoverishment protection portfolio. This is not sophisticated theory. It is the most basic framework that anyone can implement regardless of how much capital they have. The first layer is your emergency fund, which should be 6 to 12 months of expenses in very low-risk liquid assets. This remains in highly liquid accounts even though they yield little, because the function is not growth, it is protection against unforeseen events that would force you to sell investments at the worst possible moment. If you need to withdraw investments during a market crash because you don't have an emergency fund, you will crystallize losses that would only be temporary. This layer should not exceed 20% of your total assets if you are young, or 30% if you are close to retirement. The fatal mistake I constantly see is people keeping 80 or 90% of their wealth in this first layer for decades, calling it being conservative when in fact they are ensuring their impoverishment. The second layer is your real growth portfolio, which should contain 60 to 80% of your capital depending on your age and time horizon. This includes shares in productive companies that generate real profits, real estate funds that own income-generating properties, and other assets that benefit from economic growth and inflation instead of being destroyed by them. The logic is crystal clear. When you own shares in companies, you don't own paper, you own pieces of organizations that sell products, charge prices that rise with inflation, and distribute profits to you as a shareholder. If inflation doubles prices, company revenues double, profits increase, and the value of their shares grows. You are protected. When you have money in savings and inflation doubles prices, your purchasing power is cut in half. You are destroyed. Historically, American stocks have returned 6.8% above inflation over the last 120 years. This means that each dollar invested maintained purchasing power and multiplied by almost 200 times adjusted for inflation. Every dollar saved in savings barely maintained its nominal value and lost 96% of its real value. To implement this in practice, you can start with low-cost index funds that replicate the broad market. If you have $10,000 to invest and are just starting out, put $7,000 in a fund that tracks the 500 largest American companies. Low costs are critical because every 0.5% you pay in fees is 0.5% less compounded return over decades. The difference between paying 1% versus 0.1% rate per year in 50 years is losing 39% of the final equity. You worked decades to enrich the manager instead of yourself. The third layer of the portfolio is protection against extreme scenarios and represents 10 to 20% of capital. This includes assets that appreciate in value when the monetary system is under stress. Gold, physical real estate, commodities, and for those who understand, a small position in decentralized cryptocurrencies. The function of this layer is not growth, it is safety. Gold doesn't pay dividends, it doesn't generate income, but in 1833, an ounce of gold bought about the same as it buys today, about 300 loaves of bread. The dollar from 1833 bought 300 loaves of bread. Today's dollar buys 3 loaves of bread. Gold preserved purchasing power over 2 centuries. The dollar lost 99%. This doesn't mean putting half of your wealth in gold. It means that 10% in assets that don't depend on government promises is the difference between being completely destroyed in a currency crisis or just suffering a correction. I saw this happen in Argentina, in Brazil in the 80s, in Venezuela, in Turkey, in Russia in 1998. In each case, those who had 100% in local currency saw assets evaporate between 80 and 98%. Those who had 15% in gold or dollarized assets preserved the ability to rebuild later. The difference between total despair and the ability to start over was simply understanding that true diversification is not having 10 different bank accounts, it is having assets that respond differently to economic shocks. When I first implemented this 3-tier structure decades ago, it wasn't because I predicted the future or had inside information. It was simply because I studied 80 years of economic data and realized that this structure worked in 97% of possible scenarios. And when it didn't work perfectly, at least it didn't completely destroy me like it happened to those who had everything in cash. The third specific action you need to implement is what I call a disciplined rebalancing protocol based on volatility, not emotion. This is the mistake I see constantly killing investment portfolios. People allocate correctly at first, but then let emotions dictate decisions. When the market rises by 20%, they feel brave and increase exposure. When it drops 20%, they panic and sell. They do exactly the opposite of what they should. They buy expensive out of greed and sell cheap out of fear. The mathematics of rebalancing is brutal in showing how much money you leave on the table because you lack discipline. Imagine you started in 2010 with 60% in stocks and 40% in bonds. Until 2020, without rebalancing, stocks grew so much that his portfolio became 85% stocks and 15% bonds. You didn't consciously change anything. You just let winners run. It sounds smart until you understand the consequences. In 2020, when the market fell 34% in 5 weeks, his unbalanced portfolio fell 41%. If it had rebalanced annually back to 60-40, it would have only fallen 28%. A difference of 13 percentage points in a $500,000 portfolio is $65,000 of equity destroyed simply by not having the discipline to sell some of the winners when they are expensive and buy more of the losers when they are cheap. And here's what most don't understand. Rebalancing forces you to do mechanically what is psychologically impossible. Sell assets after they have risen a lot, and buy assets after they have fallen a lot. Every human instinct screams to do the opposite. Your brain wants to buy more of what has gone up because it appears to be working, and avoid what has gone down because it appears to be broken. But data from 80 years shows that the strategy of rebalancing annually adds between 0.4 and 1.1% extra return per year. In 40 years, that means the difference between having 2 million and 200,000 or 2 million and 800,000. $600,000 difference by simply having a calendar marking when to rebalance and blindly following without emotion. In practice, implement it like this. Choose 2 dates per year, perhaps the first day of January and the first day of July. On these dates, you look at your portfolio, calculate the actual percentage of each asset, and rebalance back to the target percentages. If stocks have grown from 60 to 70%, you sell 10% of the stocks and buy more bonds or other asset classes that are below the target. If stocks fell from 60 to 50%, you sell other assets and buy more shares. You do this regardless of what the news says, regardless of what your stomach feels, regardless of which asset has performed best recently. The rule is inflexible. Rebalance back to target percentages twice a year. No exceptions. No sophisticated analytics. Without trying to predict what will happen. Just cold math executed disciplinedly. When I explain this to people, the common reaction is that it seems too simple to work. And that's exactly why it works. Complexity is the enemy of execution. Sophisticated strategies that depend on 30 variables and complex analyses are abandoned at the first moment of doubt. Stupid strategy of 2 fixed dates per year performed religiously for 40 years beats 93% of sophisticated strategies abandoned after 3 years. It's not about being smart, it's about being consistent. The fourth action is to increase your savings rate in a structured way, using what I call an increasing commitment scale based on increases in income. Here's the brutal truth that few admit. It doesn't matter how good your return on investment is if you invest insignificant amounts. If you invest $500 a month at 10% a year for 30 years, you will have $1,130,000. If you invest $1,500 a month for the same return, you will have $3,380,000. The difference of an extra $1,000 per month is $2,250,000 in the end. Savings rate matters much more than investment return when you are starting out. But people do the opposite. They spend 150 hours a year researching how to get 0.5% more return and 0 hours thinking about how to save $500 a year, more per month. They are optimizing the wrong variable. Mathematics shows that in the first 10 years of accumulation, increasing the savings rate from 10 to 15% of income has a greater impact on final assets than increasing the return from 8 to 12%. But after 25 years, it is reversed. Return starts to matter more because the capital base is already large. The mistake is focusing on returns when you should focus on savings, or vice versa depending on the stage. Implement it like this. With each salary increase, promotion, or new source of income you receive, commit 50% of that additional increase to investment before increasing your lifestyle. If you earn $5,000 a month and invest $500 and receive a raise to $6,000, don't increase your investment to $600. Increase it to $1,000. Take half of the additional $1,000 and direct it towards investments before you get used to spending it. Your brain never felt like you had that extra $500 because it never went through your checking account. You maintain the $500 increase in standard of living, but ensure that wealth grows twice as fast. In 20 years, the difference between increasing investment by 10% with each increase versus 50% with each increase is $1,800,000. $800,000 versus $3,900,000. Over $2 million difference just by having the discipline to commit half of the raises to future you before spending on present you. And here is the insight I learned from observing hundreds of cases over decades. People fail in this discipline because they try to increase savings after increasing their lifestyle. They see an extra $1,000 in their account, buy a better car, rent a bigger apartment, and 2 months later they try to cut expenses to save more. Impossible. Cutting your lifestyle after increasing it is 100 times more psychologically painful than never increasing it. Order is crucial. First, automate the increase in savings, then increase your lifestyle with what's left. Never the other way around. This requires setting up automatic transfers on the same day the salary increase takes effect. If increase starts in July, set up larger automatic transfer to start in July. Don't wait to see how you feel. Don't test for a month. Automate immediately. Remove your ability to choose on a monthly basis because choice will always result in spending rather than investing. The fifth specific action is to develop what I call psychological immunity to volatility through controlled gradual exposure and education about recovery math. This is the point where 90% of people who start investing fail. They read about investing, understand the logic, allocate capital correctly, and then sell everything in a panic at the first 20% drop. They lose years of potential gains because they haven't developed the psychological muscle to withstand volatility. Volatility is not a bug in the system. It is a feature that you need to learn to use to your advantage. Let me show you the math that should immunize you against panic, but that no one explains clearly. If your investment drops 20%, it needs to rise 25% to get back to the same point. If it drops 30%, it needs to rise 42.9%. If it drops 50%, it needs to rise 100%. This asymmetry between falls and recoveries is what makes people panic. They see a 40% drop and think they only need a 40% recovery, but in reality, they need 67%. It seems impossible, so they sell it. But here's what historical data shows that completely changes the perspective. In all 14 market crashes of more than 20% since 1926, the average time to complete recovery has been 26 months. The longest was 4 years during the Great Depression. The shortest was 5 months after the crash of 2020. In 100% of cases, the market recovered and reached new historic highs. So the question is not whether you will recover, it's how long you can wait. And here's the part that few understand. If you continue investing during the downturn, buying cheaper stocks, your recovery point comes much sooner. If you had $100,000 invested, the market drops 40%, and you have $60,000, and you invest another $10,000 during the fall, you don't need the market to rise 67% to break par. It just needs to go up 43% because you bought cheaper shares. The same 40% drop that destroys those who sell and paralyzes those who just put up with it, enriches those who continue to buy. Over the past 100 years, 84% of all stock market returns have come on just 3% of trading days. 3%. This means that if you stayed out of the market in the 30 best days of the last 5 decades trying to avoid volatility, its annual return fell from 9.8% to 2.5%. He turned potential wealth from $4 million into $400,000. By trying to avoid temporary pain from volatility, you have guaranteed permanent pain from never building wealth. Psychological immunization comes from combined practice and education. Start investing small amounts until you get used to seeing red numbers without panicking. Invest $1,000 and watch for 6 months. When you see that first 15% drop, your stomach will drop, but it's only $1,000. You survive. When you recover, you learned viscerally that recovery happens. Increase it to 5,000. Go through another drop. Survive again. Each crash and bounce cycle builds psychological muscle that allows you to eventually keep hundreds of thousands invested through brutal volatility without blinking. Athletes don't start by lifting 200 kilos. They start with 20 and gradually increase. Investors shouldn't start with their entire equity in stocks. They start with 10% and increase as they build tolerance. Education comes from studying every historical crash and understanding that everyone recovered. It's not faith. It's a century-old statistical pattern. Create a document with the 15 biggest crashes in history. Date they started. Magnitude of the crash. How long until complete recovery. Print it and put it on the wall. When the next crash comes and you feel panic, look at the document. Every crash in history is there. Everyone recovered. What makes you think this one is different? It's no different. It's only his first or his third, so it feels apocalyptic. For anyone who has seen 12 crashes recover, it's Tuesday. The sixth action that separates those who build real wealth from those who stagnate is to increase income in parallel with optimizing return on capital. People choose one or the other. They focus obsessively on investing every penny and never work on increasing how much they earn. Or they just focus on moving up the career ladder and leave extra money sitting in their checking account. Both are wrong. The math is clear. If you earn $4,000 a month, save 20%, and invest at 10% a year, in 20 years you will have $460,000. If you increase your income to $6,000 while maintaining the same savings rate, you will have $690,000. If you keep your income at $4,000 but increase your return to 13%, you will have $530,000. If you do both increase income to $6,000 and return to 13%, you will have $960,000. The combination more than doubles the result compared to optimizing just one. But implementing this requires deliberate strategy on both fronts. On the income front, it means investing in skills that the market increasingly values. Data from 17 years of salary analysis shows that technical certifications in high-demand areas increase average income by 28 to 42% over 3 years. Learning a second language adds 12 to 19%. Developing sales or negotiation skills adds 21 to 38%. Changing companies every 3 to 5 years instead of remaining stagnant adds 15 to 22% per move. These are not increases that come automatically. They come from deliberate investment of time and money into becoming more valuable to the market. Most people work for 40 years at the same skill level they had at 25 and complain that their salary doesn't grow. Salary doesn't grow because the value they deliver hasn't grown. On the return front, it means constantly educating yourself about investment vehicles and optimizing costs. Every 0.5% of fees you eliminate is 0.5% more in return. In 40 years, this means 22% more equity. Trading an actively managed fund that charges 1.2% for an index fund that charges 0.03% adds hundreds of thousands of dollars over a lifetime. Learning about asset allocation and rebalancing adds another 0.5% a year. Understanding when to use tax-advantaged accounts adds another 1 to 2%, depending on the situation. These are improvements that seem small year after year, but compounded over decades represent the difference between a comfortable retirement and working until you die. The practical implementation is to dedicate 10% of your time each week improving one of the two fronts. 2 hours to learn a new skill that increases market value. 2 hours to optimize portfolio, study investment vehicles, or understand taxation. It's not about working 80 hours a week, it's about working 40 hours more strategically and using 4 extra hours to become more valuable and invest better. In 5 years, the difference made up of these 4 hours per week, it's astronomical. The 7th and final action you need to incorporate is what I call the permanent opportunity cost mindset, applied to every financial decision. This fundamentally changes how you view spending. When you're going to